Imagine that it's 1895 and the U.S. government has no gold left at all. There is almost nothing left in the Treasury's vaults. There are only a few weeks left before the U.S. economy falls apart. The president can't get Congress to do anything. International lenders are getting ready to sell all of their U.S. bonds. The whole country is on the verge of an economic collapse. And then one man walks right into the White House and makes everything better with just one phone call. His name was John Pierpont Morgan, and the thing is, he didn't save America because he loved it. He saved it because he owned too much of it to let it go up in flames. When we got to 1912, J.P. Morgan was in charge of an astonishing 25% of all the wealth in the United States. I don't mean 25% of just the money in banks. I mean 25% of everything that was there. We're talking about banks, shipping companies, insurance companies, railroads, and huge industrial companies all over the place. A full congressional investigation found that Morgan and his business partners were on the boards of 341 different companies, with a total of $22.2 billion in assets. That's about $670 billion in today's money. But here's the crazy part. The real number was much higher than that. Morgan's power went far beyond what he owned on paper. When Morgan spoke, whole markets would change right away. When Morgan chose to put money into something, everyone else would hurry to do the same. If Morgan didn't give someone credit, their whole business would die. And get this, everything he built, from the banking systems to the crisis management plans to the Federal Reserve itself, didn't go away when he died in 1913. It grew and changed. And now, in 2026, it's literally running your whole life. Morgan originally designed the system that handles your monthly mortgage payments. Morgan wrote the same playbook for every financial crisis and government bailout in 1907. We hear a lot about these too big to fail banks. They are the direct descendants of Morgan's original empire. Morgan's personal library is where the Federal Reserve, which prints all of your money, was actually made. And what about the next big financial crisis? The same strategies that Morgan came up with 130 years ago will be used to deal with it. J.P. Morgan didn't just make a lot of money for himself. He built the whole structure of what we now call crisis capitalism, which is when banks get so big and so connected to everything that the government has no choice but to save them. Where private bankers can tell elected officials what to do directly. Where one person's choice can either save or completely ruin the whole economy. And here's the really scary part. You can't get away from it. The system isn't really about J.P. Morgan, the real person. The system is the method itself, concentrating financial power, turning crises into opportunities, taking over the government and making too big to fail an official strategy. Let me show you step by step how Morgan built this whole system, how he used financial panics to get even more power, how he literally made the Federal Reserve in a secret meeting, and why 113 years after this man died, you still live in the same world that Morgan made. On April 17, 1837, John Pierpont Morgan was born in Hartford, Connecticut. His father, Junius Spencer Morgan, was already a very successful banker in London. You need to understand this right away. Morgan's story wasn't one of going from rags to riches. From the start, he had a banking network that was already in place. But the way he used that network, how much power he concentrated, and how he built a system from it, was what made him stand out as a genius. Morgan started working for his father's bank in London when he was 19. At 23, he had opened the New York branch of his father's bank. When he turned 34, he teamed up with a man named Anthony Drexel to start Drexel Morgan and Company. This company would later become J.P. Morgan and Company. Morgan and Co. Morgan knew something important that other bankers didn't from the start. It wasn't enough to just lend money to businesses to have real power. The real power came from completely changing those businesses, taking control of them from the inside, and finally owning them outright. The railroads were Morgan's first big move to gain power. In the 1870s and 1880s, American railroads were a complete mess. There were hundreds of railroad lines that were all trying to get your business. Very tough competition. Constantly destructive price wars. There's a lot of overbuilding going on all over the place. Bankruptcy after bankruptcy all the time. Most bankers stayed away from the railroad business because it was too unstable and hard to predict. But what about Morgan? Morgan saw a clear chance right in front of him. He knew that whoever was able to control the railroads would also be able to control the whole American economy. Why? Because railroads moved everything that was important. Everything: coal, steel, grain, manufactured goods, and people. If you control the railroads, you control all the trade that happens in the country. Morgan started buying up bankrupt railroads on purpose, completely changing them and then merging them into bigger companies. People started to call his method Morganization. Step by step, here's how his system worked. Morgan would step in right away to offer money to save a railroad company that was going bankrupt. But there were always very specific conditions attached to his money. Morgan chose the whole board of directors himself. Morgan put his own partners on that board. Morgan told them how to run their businesses, what routes to take, and how much to charge. Even though it wasn't technically in name only, the railroad became Morgan's property in every way that really mattered. Then Morgan would start talking to all the other railroad companies in the area to try to get a deal. He'd set up strategic mergers, get rid of all competition one by one, and make regional monopolies that he controlled. By the year 1900, Morgan was in charge of the New York Central Railroad, the Erie Railroad, the Northern Pacific Railway, the Great Northern Railway, and the Southern Railway. He also owned large stakes in many other railroad companies. Morgan owned about half of all the railroad track in the United States when you add it all up. All of it. That's not how to run a business anymore. That's running a full transportation monopoly. Morgan's power didn't stop with just railroads, though. He was in charge of all the businesses that the railroads actually helped. Morgan gave Andrew Carnegie the money to build his huge steel mills. Morgan made the biggest business deal in history up to that point in 1901. He paid $480 million for Carnegie Steel, and then combined it with a few other steel companies to make U.S. Steel. Steel was the first company to make $1 billion. U.S. Steel ended up making an incredible 67% of all the steel that was made in the United States. Morgan was the chairman in charge of everything. Now he was in charge of making steel. He was in charge of all the railroads that moved that steel around. He was in charge of all the banks that lent money to both industries. This was vertical integration on a scale that even John D. Rockefeller was envious of. But here's the thing. Morgan's real genius wasn't in starting businesses from scratch. His real skill was using financial crises to gain even more power. The Panic of 1907 is the best example of this strategy in action. In the year 1907, the economy in the United States is doing very well, but it is very unstable. Banks are taking on too much risk and are way too leveraged. Trust companies are making loans that are very risky all the time, even though they don't have to follow the same rules as regular banks. Then, in October 1907, a big scheme to bet on copper prices suddenly falls apart. The Knickerbocker Trust Company, one of New York's biggest trust companies, is publicly revealed to be completely broke and unable to pay its debts. People who put money in the bank panic right away. They rush in huge groups to take out all of their money at once. The Knickerbocker goes out of business and closes. The fear spreads quickly to other banks and trust companies in the city. People who put money in the bank are lining up for blocks to get it back right away. But here's the problem. Banks never have enough real cash on hand to pay out all of their customers at once. They are illiquid on purpose. And when everyone wants cash at the same time, the whole system just stops working and freezes. This is what we call a typical bank run situation. Many big banks are on the verge of complete failure by the middle of October. The stock market is going down a lot. The whole economy is coming to a halt. And the U.S. government has no way to deal with this at all. There's no central bank. The Federal Reserve isn't there yet. There isn't an official lender of last resort. Only J.P. Morgan. On the night of October 24, 1907, the presidents and leaders of New York's biggest banks and trust companies all met at J.P. Morgan's own private library, is at the corner of 36th Street and Madison Avenue. At this point, Morgan was 70 years old. He sat in his chair, smoking a cigar and playing solitaire by himself. One by one, each banker stepped up and gave him the full balance sheets for their bank. Morgan looked over each and every one of them very carefully. He then chose which schools would be saved and which ones would be allowed to fail and die completely. He personally put together full rescue packages for the people he thought deserved to be saved. He made all the healthy banks put money into the rescue fund. He got John D. Rockefeller to come in and put millions of his own money in the bank. Morgan promised millions more of his own money. And he made it very clear to everyone in the room that anyone who didn't fully cooperate would never be able to get credit again. This was power on display in its purest form. Morgan wasn't elected to any position. He wasn't a government worker of any kind. But at that moment, he was actually acting as the central bank for the whole United States. And he had that power for one simple reason: he had more money than anyone else alive. Morgan ran this huge rescue operation for 2 weeks straight. He made the decision himself about which banks would get emergency funds, which ones would be merged into stronger banks, and which ones would be closed for good. He kept the Trust Company of America from going out of business. He made it happen that the U.S. bought Tennessee Coal and Iron Company. He controlled steel and used the crisis as a perfect cover for this move to consolidate. He got a lot of bankers together to help the stock market stay up and not fall apart completely, which would have brought everything down. And by the beginning of November, the panic had finally died down. Morgan had saved the whole financial system from being destroyed. But this is the part that most people don't get about this story. Morgan didn't make the panic happen, but he definitely and without a doubt benefited from it. When everything was said and done, Morgan's banks had successfully taken over a number of their rivals. The U.S. Steel bought Tennessee Coal and Iron at a very low price during a fire sale. All of the weaker banks were no longer in business, and there was no doubt at all about Morgan's power now. He was now the man who saved America, the man who the government would call whenever it needed help getting out of trouble. But the panic of 1907 showed both the American public and politicians in Washington something that scared them to death. One private banker, who was not an elected official, had more real power over the economy than the whole elected government put together. If Morgan had chosen not to save the system, it would have completely fallen apart. One 70-year-old private citizen's personal goodwill literally kept the whole country's economy stable. A lot of people thought this situation was completely unacceptable. Congress quickly started official inquiries into what happened. The Pujo Committee looked into what they called the Money Trust, which was a group of people who had a lot of money. And in 1912, they came to their conclusion and said that J.P. Morgan and a small group of his friends ran the whole country's credit system through interlocking boards of directors, strategic partnerships, and a lot of money in one place. The official report made it clear that Morgan and his partners were in charge of 341 companies, which were worth a total of $22.2 billion. This was 25% of all the wealth in the United States. People were very angry when they found out about this. The progressive reform movement called for change and rules right away. The idea was to set up a central bank that would make it so that private bankers would never have to lend money in an emergency again. But here's the big twist in this tale. The Federal Reserve, which is the central bank that was actually created, was literally made by bankers themselves. More specifically, Morgan's closest friends planned it at a secret meeting. In November 1910, 6 powerful men rode together in a private luxury train car to Jekyll Island, Georgia. They only used their first names the whole time so that no one would know who they were. They worked for 10 days straight to come up with a detailed plan for a brand new central banking system. Senator Nelson Aldrich, a close friend of Morgan's and the father-in-law of John D. Rockefeller Jr., Frank Vanderlip, president of National City Bank, which Morgan owned, Henry Davison, senior partner at J.P. Morgan and Company itself, Charles Norton, president of First National Bank of New York, another Morgan bank, Benjamin Strong, vice president of Bankers Trust, another Morgan bank, and Paul Warburg, partner at Kuhn, Loeb and Company, representing Rothschild banking interests, Morgan and Company itself, Charles Norton, president of First National Bank of New York, another Morgan bank, Benjamin Strong, vice president of Bankers Trust, another Morgan bank, and Paul Warburg, a partner at Kuhn, Loeb and Company, who represented Rothschild banking interests. This was not an official government group that worked for the people. This was a private banking cartel literally making the rules that would supposedly keep them in check. The plan they made at Jekyll Island turned into the Federal Reserve Act, which Congress passed in December 1930. The official description said that the Federal Reserve was supposed to be a government agency that would keep the economy stable and stop future financial panics. But in reality, it was a central bank that was owned by its member banks and run by them. The law says that the Federal Reserve is a corporation. It has real owners who are shareholders. All of those shareholders are private banks. The biggest banks own the most of it. J.P. Morgan's different banks were founding members and owned a lot of shares. The Federal Reserve can make money out of thin air and give it to the government and private banks. Morgan used this same power personally in 1907. Now it was a permanent part of the system. The Fed would be the official lender of last resort from now on. But here's the big question: who really ran the Fed? The banks did. Morgan's banks in particular. This was the best example of regulatory capture in action. The bankers who really needed to be regulated wrote their own rules and even made their own regulator to keep an eye on them. Now let me show you how this system works today and why you are still completely stuck in it. The government and the Federal Reserve used the same playbook that Morgan had made in 1907 when the huge financial crisis of 2008 hit. The government said that the biggest banks were too big to fail. They got huge bailouts from taxpayers. Weaker institutions had to merge with stronger ones in a hurry. J.P. Morgan Chase bought Bear Stearns and Washington Mutual for very low prices during a fire sale. The same thing happened again, just like Morgan did with his competitors in 1907. To keep the system from completely falling apart, the government and the Federal Reserve made sure there was always enough money available. And the banks that came out of the 2008 crisis were even bigger and stronger than they were before it started. The people who were really responsible for the crisis were still in charge of everything. Morgan stayed in charge after 1907, and the same thing happened. J.P. Morgan Chase is the biggest bank in the U.S. with $3.9 trillion in assets. It is the direct descendant and continuation of J.P. Morgan's first bank, which opened more than 100 years ago. Financial news outlets always refer to Jamie Dimon, the current CEO, as the modern J.P. Morgan. During the COVID-19 crisis in 2020, Dimon personally coordinated the government's response by talking directly on the phone with the Treasury Secretary and the Federal Reserve Chair. Private bankers are still the ones who handle financial crises behind the scenes, just like Morgan did in 1907, and just like in 1907, they gain from the problems they are supposed to be fixing and managing. JP, when First Republic Bank went out of business in 2023, Morgan Chase got direct help from the Federal Reserve to buy it. The same thing keeps happening. A crisis happens, banks get stronger, and bailouts happen. Morgan's system is in charge of your personal life right now in 2026, whether you know it or not. You probably have a loan on your house, right? A bank that came from Morgan's original empire is most likely the one that holds or services that mortgage. J.P. Morgan Chase, Bank of America, Citigroup, and Wells Fargo all have roots in the banking consolidation wave of the early 1900s, which Morgan personally led and organized. Together, they own about 40% of all mortgage in the United States. When you pay your mortgage each month, some of the money goes to servicing fees, some to interest, and some to the principal. The interest money goes straight into the pockets of these huge banks. If you have a 30-year mortgage, you will pay 2 to 3 times the home's actual purchase price in interest alone. This transfer of wealth from regular homeowners to big banks is exactly what Morgan planned. It's not against the law. People think it's perfectly normal. And it takes trillions of dollars from American homes every year. You probably have an investment account or a 401k retirement account. Morgan built the financial system over 100 years ago, and it takes care of that money. The whole system of mutual funds, pension funds, and investment banks came about during that time of consolidation in the early 1900s. Using Morgan's basic model, all of the money you pay in fees, management costs, and transaction costs goes straight to banks. People in the U.S. pay between 1% and 2% of their investments every year just in fees. For a portfolio worth $500,000, that's $5,000 to $10,000 every year. That's hundreds of thousands of dollars going straight from you to Wall Street over the course of your life. And here's the kicker. When the economy crashes hard, your 401k loses a lot of value, but the big banks, the government saves them. In 2008, trillions of dollars in regular household wealth just disappeared. Portfolios of stocks fell by 50%. The value of homes fell by 40%. But every single one of them, including JP Morgan Chase, Bank of America, Citigroup, and Goldman Sachs, made it through just fine. They were protected by government bailouts, Federal Reserve support, and government guarantees. They came out of the crisis even stronger than they were before. In the meantime, you lost money. They got even more power. That's how Morgan's system is supposed to work. All profits are kept secret. Taxpayers bear the brunt of all losses. The banks always come out on top, you always pay. The Federal Reserve is always printing new money, which causes inflation in the economy right away. Inflation is like a secret tax on all of your savings. If you have $100,000 in cash and inflation is 3% a year, your buying power goes down by $3,000 every year. That pile of cash loses $26,000 in real value over the course of 10 years. But that money doesn't just go away. It goes to people who benefit from inflation. Who gets what? People who own assets and people who have fixed-rate debt? Do you know who the biggest borrowers are? Banks are the biggest borrowers in the whole system. They borrow money from the Fed at very low interest rates and then lend it out at much higher rates. The difference between those rates is all profit for them. They get directly more money from your inflation loss. This is the same system that Morgan helped design when his friends set up the Federal Reserve in 1910. Now let me show you the 3 times when Morgan personally saved the U.S. government from falling apart. These events make it very clear what kind of power he really has. The first time the government stepped in to help was in 1895. There was a huge problem for President Grover Cleveland. The U.S. Treasury's gold reserves were less than $100 million, which is the legal minimum amount needed to back the currency. If reserves fell any more, the U.S. would have to completely leave the gold standard. People would lose all faith in the government. Foreign lenders would freak out and sell all of their U.S. bonds right away. Default was on the way. Cleveland begged Congress for help. Congress just said no. He had no other choice. J.P. Morgan and August Belmont, who were there for the Rothschild banking interests, then walked into the White House. Morgan made the president a simple offer. He and his banking group would give the government $65 million in gold in exchange for U.S. government bonds. Morgan's group would buy those bonds and make money on them. Morgan would then sell those bonds to the general public for an even higher price, making even more money for himself. And Morgan would have complete control over when and how the gold entered the Treasury, which gave him a lot of power over government policy decisions. Cleveland had no choice in the matter at all. He agreed to Morgan's terms. Morgan set up his group of banks. The gold was sent as promised. The crisis was successfully stopped. Morgan made millions of dollars from the deal, too. Everyone in charge learned the most important lesson. When the government is in trouble, you go to Morgan. Not to Congress, not to the voters, Morgan. This set a pattern that would happen again in 1907 and then again in 2008. Private bankers save the government and make a lot of money doing it. The second bailout happened in 1907, which I already talked about in detail. Morgan was the central bank and decided which banks would live and which ones would die. But I haven't told you about one important thing yet. In 1907, the federal government was actively looking into Morgan for breaking antitrust laws. People were saying that his banks and businesses were acting like an illegal monopoly. But during the panic crisis, Morgan talked directly to President Theodore Roosevelt. Morgan really needed the government to approve U.S. Steel wants to buy the Tennessee Coal and Iron Company. Roosevelt, who was desperate to stop the financial panic from ruining everything, said yes. And what about the investigation into antitrust? Dropped quietly and forgotten. Morgan kept the government from going completely broke. The government stopped trying to break up his empire in exchange. This is the basic deal that is going on. Banks intentionally grow too large to fail and too interconnected to be effectively regulated. When a crisis comes, the government needs them to live. and the government protects them from the consequences of their help. The third bailout is less obvious but just as important. Morgan and his friends worked hard behind the scenes to get Congress to agree to make the Federal Reserve System in 1912 and 1913. They wanted a central bank that was set up to help private banks, not the general public, and you know what? They got what they wanted. The Federal Reserve Act, as it was actually passed into law, set up a system in which private banks literally owned the Fed. The Fed's main job was to protect the solvency of banks, and it could make as much money as it wanted to bail out banks in any crisis. This was the biggest bailout ever. Morgan helped set up a permanent rescue system just for his own industry that would last forever. In 1929, 1933, 1987, 2008, 2020, and 2023, the Federal Reserve gave banks money to help them out. Every time, Morgan used the same playbook from 1907. Now let me show you the evil genius behind Morgan's system of power. Most people couldn't see how powerful he was. Morgan hardly ever talked to reporters. He didn't want to be famous or get attention. He did all of his work behind the scenes. In 1900, most Americans had no idea how much Morgan really controlled. They knew his name because he was famous, but they didn't know how powerful he really was. And that's exactly how Morgan wanted it to be. Power that is easy to see draws regulation and pushback. Invisible power builds up in the shadows without anyone noticing. The Pujo Committee looked into Morgan's power in 1912 and told him to testify before Congress. Samuel Untermeyer, a member of Congress, asked him directly. The exchange is well known in history. Isn't commercial credit mostly based on money or property? Untermeyer asked. Morgan said, "No, sir. The first thing is character," Untermeyer pushed, "before money or property." Morgan said firmly, "Before money or anything else. Money can't buy it." People often say that this answer shows that Morgan is honest and principled. But it really shows something much darker about how power works. Morgan's power didn't come from the money he had, even though he had a lot of it. It was based on trust and connections among people in high society. In Morgan's world, character meant, who do you know? Who believes in you? When things go wrong, who will really answer your phone? Morgan was in charge of credit. Not because he had the most money, though he did have a lot of it, but because everyone at the top trusted him to make the right choice when it counted. And that trust gave him more real power than any amount of money could ever give him. In a real crisis, governments and banks don't ask, who has the most money? They ask, who can actually come up with a solution that works? And the answer was always Morgan. Let me show you how this same thing works in the present day. When Lehman Brothers was falling apart in 2008, Treasury Secretary Hank Paulson and Fed Chair Ben Bernanke didn't just make decisions about policy by themselves in government offices. They were always on the phone with Jamie Dimon of J.P. Morgan Chase, Lloyd Blankfein of Goldman Sachs, and other big bank CEOs. The bankers told government officials directly which banks to save, which ones to let fail, and how to set up all the bailouts. It was okay for Lehman Brothers to go out of business. Bear Stearns was saved when the government made J.P. Morgan Chase buy it with huge guarantees. AIG was saved because it owed a lot of money to Goldman Sachs and other big banks. This wasn't the government making decisions on its own for the good of the people. This was the government working with banks to make rules that specifically protected those banks. The same thing happened with Morgan in 1907. And why does the government always go to the biggest banks when there is a problem? Because those banks are now literally too big to fail. If J.P. Morgan Chase went out of business today, it would quickly bring down dozens of other big banks in a chain reaction. The whole credit system would stop working. There would be no processing of mortgage. Credit cards wouldn't work. ATMs would run out of money in a few days. The economy would fall apart in days, not weeks. So the government has no choice but to save J.P. Morgan Chase at all costs. The bank is well aware of this fact. Morgan's last big idea and legacy is to make yourself completely necessary to the system and then set your own rules. Here's how this whole system works so that you can't escape it. The biggest banks are all linked by trillions of dollars in derivative contracts with each other. J.P. Morgan Chase has $60 trillion in notional derivative exposure. Bank of America has $50 trillion. Citigroup has $47 trillion. These are complicated insurance contracts, interest rate swaps, and credit default swaps. In short, they're all bets that banks make with each other all the time. If one big bank doesn't pay back the money it owes, all the other banks it owes money to also fail, which starts a chain reaction that leads to a complete collapse. In the business world, this is called counterparty risk. In practice, this means that all of the big banks are really just one big bank. If one of them fails, they all risk failing. So the government must save all of them during a crisis, not just one. This connection was planned, not an accident. Morgan knew as early as 1907 that banks that are very connected become a single entity that is too big to fail. These derivative contracts have made this problem 10 times worse for modern banks. Now, let me get right to the conspiracy theories. People often say that Morgan is some kind of puppet master who secretly controls everything from the shadows. That picture isn't accurate, and it actually makes it harder to see how the real system works. Morgan wasn't like a dictator who controlled the government. He didn't secretly cause financial crises from behind a curtain. He was a banker who knew more about leverage, information, and timing than anyone else. He used crises that happened naturally in the markets to gain more power in a smart way. He didn't make the panic of 1907 happen out of thin air, but he did everything he could to make sure he was needed when it did happen. And the system he made isn't working in the dark. Anyone can read congressional reports, banking rules, and Federal Reserve structure documents that fully explain it. It's not a secret plot that is hiding in the shadows. It's just a business structure that gives a lot of power to the people who already have it. And that exact structure is legal, widely accepted, and used by every major bank in the world today. Morgan knew something that most people still don't understand. Over time, power will always become more concentrated in capitalism. Competition naturally leads to consolidation. Companies that are weak either fail or get bought by stronger ones. Strong companies keep getting bigger. After a while, every industry becomes dominated by a small number of companies that control everything. Banking is just like any other business. Morgan sped up this natural process with his crisis management skills, but it would have happened anyway, even if he hadn't been there. He was a genius for putting himself at the very center of the process as it happened and making himself necessary. The Federal Reserve made what Morgan did personally into a law. It gave a small number of institutions the power to decide who gets credit and who doesn't. So what do you really do about all of this? What do you do when you can't get away from a system? You have 3 real choices. Option 1, fully accept it. Know that too big to fail and banking concentration are normal parts of modern finance, not problems or accidents. Take advantage of the system's tools like mortgage, credit, and investment accounts. Take advantage of the system's stability, even though you know it will charge you fees. Most people pick this option because it's really tiring and usually pointless to fight the system. Option 2, take as little from you as possible. Cut down on your debt by a lot. Pay off your mortgage early to save a lot of money on interest over time. Instead of expensive actively managed funds, use cheap index funds. Instead of going to the big banks, go to your local credit union. Keep as little cash as possible in the banking system. Gold, real estate, and Bitcoin are all examples of hard assets that are not part of the financial system. This method makes it harder for the system to take money from you over your lifetime. Option 3. Find your place in the system. If you really can't get out of the extraction process, then own the extractors themselves. You can buy shares directly in Bank of America, Goldman Sachs, and JP Morgan Chase. If these banks make money off of crisis after crisis and bailout after bailout, you should buy shares in them. If the government takes money from taxpayers and gives it to banks, be a bank shareholder who benefits. This is not moral, but it makes perfect sense. The system purposefully directs wealth into these particular institutions. So, own parts of those institutions. JP Morgan passed away on March 31, 1913. At the age of 75, he lived just long enough to see the Federal Reserve Act become law. His friends had set up the Federal Reserve to keep his system going forever. His personal estate was worth $80 million, which is about $2.4 billion in today's money. But his real power was worth a lot more than that. When John D. Rockefeller heard that Morgan's will had been read in public, he was surprised and said, "And to think he wasn't even a rich man." But Rockefeller completely missed what made Morgan powerful. Morgan's power was never based on how much money he had. It was about how he controlled the wealth of other people all over the system. He was in charge of the credit that paid for railroads, steel mills, and whole industries all over the United States. He was in charge of the banks that kept everyone's money safe. He was in charge of the whole system. And the system was worth 1,000,000 times more than any one person's fortune could ever be. J.P. Morgan Chase has $3.9 trillion in total assets as of today. 2026. That's more than what Germany's GDP is worth. Bank of America has $3.1 trillion. Citigroup has $2.4 trillion. Wells Fargo has $1.9 trillion. The top 4 banks alone control more than $11 trillion in assets. They are the modern version of Morgan's empire, which is still going strong. They are too big to fail, too connected to be regulated, and too powerful to be fought against. And they get bigger and stronger every time there's a big problem. They took over failed competitors in 2008. They got help from the Fed in 2020 and got even bigger. First Republic Bank was bought by J.P. Morgan Chase in 2023. Morgan set a pattern 120 years ago that keeps repeating over and over. You can't get away from J.P. Morgan's system in today's world. Banks he built over 100 years ago handle your mortgage. Banks and other institutions that hold your money are set up using his basic model. He uses the same playbook to deal with financial crises. The Federal Reserve that he helped start prints the money you have now. And when the next big problem happens, the government will call Jamie Dimon. Just like it did Morgan in 1907, the system isn't really about people or personalities, it's all about power and structure. Power over money in one place. Crisis as a chance to bring things together. The government relies on private banks. Too big to fail as a permanent policy. If this video showed you a system you'd never seen before, and you now know that one man built the banking structures that control your whole life 120 years ago, subscribe to this channel right away. Because the first thing you need to do to get around the system is understand it. You can't get away from Morgan's banking system, but you can see it clearly. And seeing it changes everything about how you work in it. J.P. Morgan started crisis capitalism. The idea that some businesses are too big to fail, the Federal Reserve, and the government giving money to private banks in trouble. That system is modern finance. And you live in it every day.